Alrighty, so welcome to today's Facebook Live. On this video, I'm going to show you 5 powerful ways to drastically reduce your tax burden. Now, in this great country, taxes are not only a responsibility, kind of a privilege, depends on how you look at it. You know, we all got to pay our fair share. I'm up to that. But the question is, what is our fair share? And the fair share is exactly what the IRS says we have to pay. And so, as a business owner, it is absolutely up to you to use all of the advantages, yes I said advantages, that the IRS gives you according to the IRS code. So what I'm going to do is go over just 5, there's more, but just 5 of the strategies that you can use to drastically reduce your tax burden. I'll tell you, if you're watching this video and you're in real estate, then you are in for an awesome treat, okay? But what I'm going to do first, because I'm going to only give you 2 of these strategies on this personal page, and we're going to put the comment on the stream right now. And we're going to give you the, if you want to do that right now, it'd be great. So we're going to give you the comment. You got to like my Facebook page, which I'm going to put on here in just a second to get the last 3. I'm going to go over 2 to start with. Okay. So first of all, you can do deals in your IRA. Okay. Now this is so powerful because an IRA is an amazing tool. There's a couple different kinds of IRAs. I'm going to talk about Roth IRAs in it right now, okay? A Roth IRA is a retirement account, and by the way, I'm not an accountant, not an attorney, not giving you any legal advice, I'm just telling you what we do right now. So, a Roth IRA is awesome. So a Roth IRA is a retirement account vehicle, savings vehicle, where you take after-tax income, meaning you will say you make $100,000, and you can put, I think it's like $5,500 this year, into that money. But you paid the tax on money, and you have $5,500 left over of after-tax income that you can contribute, that's a very important word by the way, contribute to your Roth IRA. But the question becomes, well gosh Jim, how in the world can I do real estate deals if I'm only contributing $5,500 a year? It's going to take me 10 or 15 years, maybe 8 years with interest, to accumulate enough money to be able to buy a deal in my Roth IRA. Wrong answer. Super cool tip coming up right here. So here we are. And it's going to be a long video because this is super cool. Let's put the comment for the fan page, and what we're going to do is you want to like, oh, you did it already, cool. So for the Roth IRA, it can borrow money. What? So just as you as a private real estate investor right now, an individual or your LLC, borrows money from a private lender or hard money lender, here's what's super cool, is your Roth IRA can do the same thing. So picture this, let's say your Roth IRA puts a $1,000 deposit to buy a house, right? And then your private lender, like on a regular deal, sends the money to the title company, and then the title company then sends the proceeds, so you're buying it for $100, you're putting in 50 grand to work, sends that $50,000 roughly to your account administrator so they can write the checks to your contractor. Super cool. Bottom line is, you do not need to have enough money in your Roth IRA to do deals. Your Roth IRA can borrow the money to do the deal. One little caveat to that is your Roth IRA, retirement account, the government, I think this is actually a good decision, the government has said that they do not want a retirement account jeopardizing itself. And so your retirement account has to borrow what's called non-recourse loans. Non-recourse means that in the event that the retirement account defaults on that loan, okay, in the event that somebody's defaulted on that loan, then the way it works is the lender cannot come after any assets owned by any assets in the account. It can only come after the asset that's borrowing against only. So in other words, it can only get the property back. It can't go after anything in there. I tell you. So then the question is, well, gosh, how does that help me with my taxes? Well, here's the deal. Any profits made in a Roth IRA are completely tax-free. Tax-free. Now, I don't care what tax bracket you're at personally. They're completely tax-free if you wait until you're 59 and a half to take out to do withdrawal, okay? To make a distribution, take a distribution. So I can spend an hour talking about how to do deals there. Bottom line is, your Roth IRA puts up the deposit to buy the property. Your Roth IRA borrows the money, okay, on a non-recourse loan. Then the proceeds from the private lender go to the administrator. The administrator writes the checks to the contractors. And then fourth, the proceeds from the sale of the property, the profit on the deal, goes back into your Roth IRA account. And you can't touch it until you're 59 and a half or older. 59 and a half, okay? I kid you not. All right, so 59 and a half or older is what you need to be at to be able to get those. Now, There's a couple of things like income limits and stuff like that. And when you like my fan page at the end of the video, Corey, if you would remind me to give them the tip on the Roth IRAs if there's an income limit issue. So that's going to be a 6th tip. Okay. So we're going to do a 6th strategy tip at the end of the video on the one on the fan page. I'm going to show you how to get a Roth IRA even if you make more than the amount allowed. Okay. So that's the IRA. Well, I just did something. I got to erase this. Check out this electronic. Boom. Erase. There we go. All right. So next is a 401k. Now you're probably thinking to yourself, Jim, I'm a small business owner. What do I need a 401k for? Well, there's 2 kinds, as far as I know, and for all intents and purposes for this discussion, there are 2 kinds of 401ks. All right. So the 401ks. We're going to talk about what's called a solo 401k. Again, not doing your legal or accounting advice here, just telling you what we do, what I've learned to run my own business, and to save myself 6 figures of taxes from 2015 to 2016, right? So huge check, not a very big check, all right? $250,000 to $30,000 tax bill, roughly, between various entities. So it's pretty cool. So oops, I'm still on the eraser, my bad. 401k. So here's the way this works. A 401k, you can set up a 401k that matches the contributions. So let's say that you, the individual, is a beneficiary of a 401k for your company. You have a 401k with the LLC that you own. Here's the way it works. You, as an individual, are allowed to contribute, that's the key word, contribute pre-tax income. Okay, so let's say you make $100,000, right? I think you contribute, $35,000 or so, roughly, I forget the exact, $36,000, something like that, $36,000, okay? You can contribute $36,000 of pre-tax income. So if you made $100,000 personally, now your tax burden is only on, $64,000. $100,000 minus 36 is 64. Now you're only paying taxes on the $64,000 of income. Super cool, right? Not only that, but you can, but your company can match up to a certain point. I think it's 50% up to $17,000 or $16,000. All I know is, between my wife and me, we put in a little over $100,000 in here. In other words, I contributed personally to reduce my personal tax burden, okay? Then my company matched a portion, I forget exactly how much, it's like $50,000 or $60,000 per person after it's all said and done. So it's like 36 plus I think $16,000 or $18,000 that my company matches. Now my company matches the money I contributed. What does that do? That creates a write-off. That's a write-off for my company. So let's say my company netted $300,000 and it contributes $15,000 to my 401k. Now, here's the cool thing, that $15,000, as far as I know, that's not taxable income to me, but that $15,000 is a write-off. So if it netted $300,000, now it only netted $285,000. Make sense? So let me rewind and start over. So if I've got a 401k, so I contribute pre-tax income, reduce my tax burden personally. Then my company matches. That match is a write-off for the LLC, the company that I own. Super cool, right? Now, that is, if it's a traditional 401k, what that means is that the profits from any deals that entity does are taxable when you take the money out. Not when the profits are incurred to the 401k, but when I take the money out, which I can do anytime I want, right? So that's called a tax deferred. A Roth IRA, let me write the word Roth here. Hopefully you can see the screen. So a Roth IRA is tax-free, as long as you take the money out at 59 and a half or older. A 401k is tax deferred, meaning so I don't pay tax on what I put in, but I pay tax on the profit that it made on doing deals. So you can see how this can quickly add up to a decent amount of money. But here's the cool thing. Your 401k can also borrow private money the same way your IRA does. Super cool, right? Now if you want to get really technical here for a second, your 401k can have what's called a Roth traditional split, okay? Roth traditional split. So again, I think it is $36,000 and $18,000. So if I personally contribute $36,000, okay, my pre-tax income, I can choose to make this $36,000 be after-tax income. In other words, let's say that I personally make $100,000 and I want to put 36 grand into it. I've got to pay tax on the whole $100,000 and then take 36,000 of the after-tax dollars to contribute to this 401k. Now, why would I do that instead of pre-tax dollars? Here's why. Because the 401k, I said it's traditional, meaning it's tax deferred. If I contribute the proportion of the value of the 401k that I contribute to with after-tax income, it can be taxed as a Roth, which means when I take it out, it's tax-free. So we got basically a 2-to-1 ratio. So let's say after a few years, it's got a $300,000. I think there's an age limit I have to take it out by. So when I take it out, let's say that it's got a $300,000 value, 200 would be tax-free, 100 would not be. It would be taxable at my rate at the point I take it out. So that's a Roth traditional split. Pretty technical. If you're just starting out, just get a solo, self-directed solo 401k. All right, so these were some seriously kick-butt strategies that will save you tens of thousands of dollars per year in taxes if you implement them. So if you want to learn about DPAD, living above the bottom line, some other cool, really cool stuff, then what you've got to do is just a shameless bribe. You've got to like my fan page right now. We're going to go over to a different device, and you've got to go over to my fan page, and I'm about to start another video and go over these next few tax saving strategies. So go ahead, click my fan page right now, like it, and I'll see you over there in about 30 seconds, and we're going to go over the rest of these tax saving strategies. So I'll see you there. Let's go ahead and finish the video. Thanks. See you in a minute. Go over to the fan page. Technical difficulties, you're in luck. Like the fan page, more videos over there. So we're back on the personal Facebook Live video, and I'm going to go over the remaining tax strategy tips because I promised them to you. So here they are. So there's this cool thing called DPAD. I think this is how it looks on your tax form. I forget what form that is. But basically, the proportion of the expenses you spend on capital improvements, developing stuff, which would be your construction expenses, okay, developing land, okay, your construction expenses, is subject to a 9% write-off. It's a DPAD write-off. So 9% of the amount of money that you spend on on construction, all the money you spend on construction, of course, a year, is subject to a 9% tax write-off. Super duper cool. Ask your accountant about it. You'll probably need to educate him about it because my accountant didn't know me about it. Tell you some investor friends. Tell me about it. Another CPA. He researched it. Sure enough, what do you know? He missed something. Go figure. All right. Now next, this could be a really long list, and that is living above the bottom line. Okay. So as an individual, okay, what are some things you have to pay for on a regular basis? You got to pay for your car, your gas, your insurance, your repairs, your tires, your brakes, your cell phone, right? All of your home or your rent if you rent a house, right? What are some other things you got to pay for travel, right? Maybe you and your better half get around a lot. Maybe you want to take one really nice vacation per year, right? Maybe there's a million different things you can write off. The point is, every time you go to spend money, every time you go to spend money, ask yourself, can I possibly write this off? This will require a little bit of education on your part as to different things that you can write off. So the percentage, for example, again, not giving you legal or accounting advice here, the percentage of the square footage of your house that is used as an office is the percentage of your overall housing expense that you can write off, which is super duper cool. Super duper cool. You can pay for your fuel, provided you can either do one of two things. You can either track your mileage for business, okay? Track your mileage for business, and the miles that are used in business-related endeavors, you can write that off as 56 cents. Excuse me, 56 cents per mile, something like that. Check the IRS website; it changes every year. And you got to weigh these things out and find out which is more. There's cool apps for tracking your mileage, by the way. Or what you can do is, if let's say it's more expensive for you to buy the car, and you've got your maintenance and your upkeep and your fuel, you can either deduct the mileage or deduct all the expenses prorated for the proportion of the miles that are business. So you're either deducting a certain amount per mile for the business related, or let's say you drive 10,000 miles in the course of a year, 4,000 for personal, 6,000 for business, right? Then you would take 60% of your expenses for the vehicle and deduct those from the bottom line as well. Super cool. So that's another way to get a write-off. I forget what was H supposed to stand for. What in the world was that for? I'll come back to that in a minute. I think I know what it's for. All right. Oh yeah, this is it. So healthcare. This is super cool. I am absolutely no expert on this, but I do know enough. So we have what's called an HSA. Write this down. Health Savings Account. A health savings account is super cool. So you can it's basically a way of forced savings account where you can spend money and then get reimbursed. It's a write-off. Ask your accountant to tell you about a self-directed HSA, health savings account. It's a way for you to reimburse yourself and for your legitimate way for your health expenses to be a write-off for your company. Again, I said earlier, every time you spend money, ask yourself, how can this be a write-off? Well, now you go to the dentist, the chiropractor, the acupuncture dude, whoever, right? You go to, if you have an HSA set up, health savings account set up, then what you can do is if your company has that set up, you pay for the expense personally, and then it gets reimbursed by the company. Of course, that's a tax-free. Reimbursements are not taxed, okay? Super cool. So if you're going to have a kid, or you got what are those things called? Braces for some kids. All these different things can be deducted. Super cool. Next is income limits. This is super cool. So earlier in the video, I talked about Roth IRAs. Now, I forget the exact income limit, but I think this is it. If you're an individual, meaning not married, and you make more than, I think it's $150,000, you cannot open a Roth IRA. So on your personal tax return, do you gross $150,000 or more? If the answer is yes, the IRS says you cannot open a Roth IRA. If you're married, if the two of you collectively make more than $250,000, $250,000 per year, you cannot open. You can have, if you opened it before your income was not that high, you cannot open a Roth IRA. But whenever whenever as a business owner, whenever somebody tells you something is not possible, but the thing you want to do be really beneficial to you, always ask yourself, well, one, who else might have done that before? And then two, just figure out a way to get around it. So here's a really cool way to do it. So if your income is $150,000 or above, if you're single, or $250,000 and above, if you're married, here's a way to start a Roth IRA if you've not done that already. So what you do, let me just make a little box here. All right, so what you do is you open a traditional, that is an N, traditional IRA. And let's say that you contribute $1,000, okay? Now, that is after-tax money it's pre-tax money putting in $1,000 in, okay? So it's pre-tax. So the government says, listen, you can convert a traditional IRA, which is a tax-deferred retirement device, you put in with pre-tax income in there, you can convert that to a Roth IRA, but there's a significant tax hit. In other words, the assets, the value of the traditional IRA is taxable, and I forget exactly how it's calculated, because think about it now. Now any profits, if it goes to a, there we go. If you convert to a Roth IRA, now any profits that the Roth IRA makes are tax-free as long as you take them out when you're 59 and a half or older. And so the assets of the traditional IRA are taxable. It makes sense, because they were going to make money, when the IRS was going to make money when you took the money out, but now they're not going to. So they say, hey, when you make that conversion, that's the word, by the way, conversion, or roll it over, I think is what it's called. Yeah, roll it over to a Roth IRA, that's a taxable event, is the word, taxable event. So the question is, how can we reduce the amount of the assets in the traditional IRA? So let's say you already have one, you've been contributing to it faithfully for 10, 12, 15 years. Say it's got a couple $100,000 in there. Well, you don't want to have all of that subject to it. So what you can do is open up another traditional IRA. And I use Gamma Plan, by the way. I think this is their website for gammaplan.com. Okay? So what you can do is open up a new traditional IRA, put $1,000 in it, right? Now, what's the asset value of the traditional IRA? $1,000. So when you convert it and roll it over to a Roth IRA, how much money is taxable to that they're subject to that taxable event. $1,000. I don't care what it is, it's not that much money. Now, let's say, and you can pay that personally or out of the account, but so you pay it personally. Now, once you convert it to a Roth IRA, you have established a Roth IRA even though you were above the income limit, okay? Which again is 150 or 250, as memory serves me, single versus married. So that's how you can establish a Roth IRA if you don't have one already, even if your income is above this single or married. Super cool tax saving strategy. Now there's one, oh yeah, this was the one earlier I meant to mention, and that is rentals. So I'm out of room, I can start a new board. So this is cool. So this is actually tip number, I'm getting carried away here today. So, rentals, that's another awesome way to save money. So it's taxable. I'm sorry, you can get all sorts of awesome write-ups, depreciation, long-term capital gains tax, all that kind of stuff. Really cool. But what are the problems with rentals, right? You have the 3 T's of rentals. Can anybody comment on that right now and tell me what the 3 T's of landlording are? Go ahead and comment right now, the 3 T's of landlord. Super cool. So it's awesome, but it can be a real hassle, right? It can be a real hassle. So we've got the tenants, which with rentals, you'll never totally get rid of tenants. But when I say tenant, I mean somebody living in that place that you own. Tenants, then we've got toilets. Toilets, what's wrong with toilets? They clog, don't they? They clog, that's no fun. So tenants, toilets, and then we've got trash. When they move out, there's all sorts of trash behind. You leave trash in your curbs and you get these $50 fines from the city. So tenants, toilets, and trash, super duper annoying. So what's super cool is I, not that long ago, came across this gentleman named Scott Myers. And turns out he is like a nationwide known expert at self-storage facilities. So I'm going to write that down. Self-storage facilities, okay? Now, why am I talking about self-storage facilities? One, it's awesome in terms of tax strategies, right? Great way to save money because it's a rental, it's long-term income, and you get depreciation, all that DPAD, all that kind of cool stuff, right? But you don't have any toilets. You don't have to deal with any trash. Oh, but wait, Jim. What if somebody leaves their stuff behind on the, they don't pay the rent and leave their junk in the self-storage locker? What's going to happen? Well, first of all, you have to advertise for 2 weeks that, hey, look, we're going to auction off this person's junk. If they don't come pick it up, you get to sell their junk and keep the money. How cool is that? Super duper cool. So there's no trash, there's no plumbing at these darn places, these facilities, right? Of course you get tenants, but just the stuff. And I forget the national average, like something like 6 months. Every 6 months that people come look at their, come even visit their self-storage locker. Now, here's another super cool thing. So what happens in a down economy? Always going to ask yourself, in any business, what's going to happen when the economy turns down? Well, you tell me, what do people do when the economy turns down in terms of their housing arrangement? What are some things they do? They sell. Another thing is they combine households and move in together, right? So maybe families combine, you got 2 generations living together, or maybe 3, right? So the question is, if you've got a house and you've got another house, like this artwork here, this is fun, right? You got another house, you got 2 houses moving into just one, maybe slightly larger house. What are you going to do with all the junk from these 2 houses? What are you going to do with that junk? Well, you're going to go find a self-storage facility and put the junk in the self-storage facility. So it's super cool. Self-storage facilities, the average lease is way long. There's no plumbing to deal with. You don't have to deal with their trash and their nonsense. The evictions are way easy. 2 weeks and you get to sell their stuff. That's awesome. So people literally pay to move it out. And also, then when the economy takes a dump, it actually gets even better. Super cool. So what Scott's done, this gentleman who's going to speak at the Greater Philadelphia RIA meeting, what he has done is he has actually broken this, if we can put this link in here, it'd be awesome. He's actually broken this down into, let me put that link there, into a system. So he's figured out how to analyze markets, okay, how to fund the deals. And if you go to gprea.com, you can actually print out a free guest pass for Thursday's meeting. Super cool. So how to analyze the deals, how to fund the deals, and also, this is super cool, how to find existing deals, really cool. And then also, he teaches you how to drive income. So the rentals of the storage facilities themselves is actually only part of, the majority, but part of the income. What are some other things you can do with your self-storage facilities? You can put up cell towers, right? Right? You can sell U-Haul rentals, right? Boxes, etc. Right? And there's other things as well. So it's not only just the self-storage facility itself, but it's all these other different things that you can do as well. My point is, Scott has had to figure out how to do this. Even if you don't have a ton of money yourself to put into this, he shows you how to get the funding, how to find the deals, how to construct the deals if that's what you're going to do, and shows you how to drive the income to make it as profitable as possible. He's a super duper smart guy, super duper nice, super duper honest. So it's this Thursday, February 2nd, and you need to get to that meeting. It's the Greater Philadelphia RIA meeting, so go to gpreia.com. That's not two R's, that's a P. That looks like a P, right? gpreia.com, Greater Philadelphia RIA. It's Thursday, February 2nd at the Courtyard Marriott. We've also got a full-day workshop with Scott 2 days later on February 4th in King of Prussia. So super cool event. If you're wanting to know a really cool way not only save your tax money, but also drive up your income, this is how you do it. So as soon as we're done putting the link in there, we're going to finish this video, but this is a super exciting event. I'm going to be there taking notes like crazy, and I look forward to seeing you there. So I'll see you on Thursday. Go to gpreia.com to register. See you there.